Next on our agenda, we are talking about ESG. We've got a great panel for you. Note that this is a live session, so that means you can submit your questions. And with that said, let me hand over to you, Michelle Dunstan, our Chief Responsibility Officer. Michelle, take it away.
Great. Thank you so much, Sarah. First of all, I'm going to apologize. I am just getting over a cold, so my voice is a little rough. I hope people can understand me. So as Sarah said, I am our Chief Responsibility Officer here at Janus Henderson, and I am delighted to introduce my fellow panelists, Demesha Hill, our Head of Diversity and Community Relations, and Alison Porter, our Global Technology Portfolio Manager. And I'd like to reiterate to the journalists that the Q&A function is open should you want to submit a question. So I'm going to start by outlining our three-pillar approach to responsibility. The first is actually our own corporate responsibility. We are out there asking our portfolio companies to do things better or do things differently. Our own practices should reflect what we expect of our holdings. The second is ESG integration. Where there is a financially material, environmental, social, or governance factor, we should be treating that the exact same way that we do any other financially material factor, which is incorporating it at each appropriate stage of our investment management process. And the last pillar is for our clients who want to go above and beyond just investing for risk and return. We have a suite of ESG-focused strategies that have dual goals, and ESG alongside that financial objective. So we're going to walk you through a little bit on each of those pillars. And I want to start with Demesha. Now, we both know that corporate responsibility is paramount at Janus Henderson. When I joined in January, I was actually delighted to learn that from an environmental standpoint, Janus Henderson has been carbon neutral for the past 15 years. Demesha, you focus on multiple aspects of the social, the S pillar of ESG. Can you share with us the other ways in which we bring focus to both our employees, especially from a DE&I perspective, but also how we work with our communities?
Absolutely, Michelle. To truly understand the impact we're making within diversity, equity, and inclusion, we have to really go beyond employee representation. Many of the ways in which we evaluate this work is through the way in which we're creating an inclusive work environment. We leverage our employee engagement score and survey to measure how inclusive is our work organization. In addition to leveraging the employee engagement survey, we also want to look at things such as, are we creating this environment where people have this sense of belonging? We have a series where people actually share their lived experiences so they feel more comfortable bringing their true and authentic self to the workplace. We integrate this work into our recruitment processes by sourcing candidates from underrepresented backgrounds and making sure that we have diversity among our interview panelists. In addition to that, we're also focused in on career pathing, succession planning, and professional development, making sure that we're looking at each step in the employee life cycle to ensure that there's inclusion being incorporated, as well as making sure that we're integrating this work into our supplier business programs. The first step in that process is making sure that those diverse businesses have an opportunity to bid on those service opportunities at Janus Henderson. We partner with diverse-owned brokers, and we're starting to actually track our overall spend with those organizations. In addition, during the RFP, in the contracting process, we're actually asking those suppliers what's their commitment to DE&I within their own organization. In addition to focusing in on this work internally, we're also leveraging our philanthropic efforts to evaluate our community partners and making sure that we're focused on those underserved communities and underrepresented groups. There's several ways in which we do this. One of the ways in which we do this is through the Janus Henderson Charity Challenge. The Charity Challenge is a unique opportunity to, one, get our employees connected and engaged with the work of the Janus Henderson Foundation. But the other piece is that it allows us to support large and more smaller nonprofit organizations that are doing the work in the community. This is another way in which we're actually making some strong commitments in supporting the things that we do from an ESG standpoint, and really making sure that our philanthropic dollars are going to those organizations on the ground that are making the biggest impact. Through the Janus Henderson Charity Challenge, we've been able to donate over $1.7 million to over 300 charities that have been nominated by our employees. But the primary focus of the foundation is really ensuring that youth reach their full potential through educational outcomes. We've invested in innovative educational programs such as Chapter One, the Greenwood Project, and we also provide post-secondary scholarships to students from underrepresented backgrounds. Michelle, this is just a few examples of how we're kind of integrating and really showing our commitment to corporate responsibility.
Thanks so much, Demesha. And like I said, I just joined in January, and I have been so impressed with what we are doing, particularly in our communities. People at Janus Henderson truly do care and want to make a difference. I'm going to talk a little bit about our second pillar, ESG integration. And I want to start off by addressing some of the confusion that's been created by the industry not having precise terms. At Janus Henderson, we want to be very clear on what we mean. For us, ESG integration is very much financially material and fundamental to what we do. It is not values-based. Not everyone's values align. And when you look at values-based strategies, they tend to have multiple exclusions, and that makes it very hard to make the risk-return characteristics our clients are looking for. It's also not the opposite. It's also not looking at touchy-feely things, like does the company have a therapy koala? I mean, it's cute and everything, you can cuddle it, but it doesn't have a material impact on a company's financial outcomes. What we are talking about here are real material issues. For instance, let's take a company that owns factories that emit a lot of carbon. Is carbon being taxed in the jurisdictions in which those factories operate? You should be incorporating that in your cash flows and financial analysis. If it's not taxed today, but taxed at some point in the future, as a portfolio manager, I'd want to know if there's going to be a cash flow out the door over the next 2 or 3 years. What if regulations are going to change and this factory is going to have to install scrubbers or upgrade its equipment, and that's going to cost them $1 billion? Again, that is a tangible financial impact on the company. Or what if a competitor has developed a new lower carbon alternative and your company is going to lose market share? Again, all of these things have impact on cash flows, valuation, cost of capital. These are things that matter to us as investors. And ESG integration at Janus Henderson is based on the same philosophy with which we have approached our research for decades. It's thoughtful, practical, research-based, and forward-looking. It's not widespread exclusions or making decisions on factors that don't have a financial impact. It's also not outsourcing our ESG research to third-party ratings agencies and just looking at their opinion. It's about training that same deep research bench and research lens on ESG issues that generate differentiated and actionable investment insights. It's this more thorough analysis of risk and better identification of opportunity that leads to better results for our clients. And when we think about it, we want to integrate it at each appropriate stage of our process. Our idea generation, our research, our financial modeling, our decisions, our engagement, and for equities, for our proxy voting. On engagement, this is one of the things that we do, and we do it for 2 reasons. First of all, we engage for insight, to understand what a company is doing and leverage that in our investment process. But we also engage for action. This is where we try and encourage companies to take decisions that are in the best interests of their long-term cash flows. We always tie this back to what we are asking for and why. How will it make this a better company? Will it enhance the company's cash flows? Will it increase the valuation? Will it reduce the cost of capital? So we very much approach ESG integration as another element of our toolkit. It's us understanding the issuers and companies that we are investing in better and leveraging it to make better decisions for our clients. So Alison, you're a very interesting individual in that you manage a couple of strategies. You manage both a strategy that integrates ESG and a sustainable strategy, an ESG-focused strategy that has those dual purposes, a sustainable ESG objective alongside the financial objective. So can you talk to me a little bit about this? How do you manage this mandate? Do you think there's a compromise when investing with an environmental or societal purpose towards ensuring that the financial returns the clients expect?
Good afternoon. Thank you, Michelle. I manage two different strategies, and there are key differences in how we manage for ESG integration versus that investment with purpose sustainable strategy. But a core point I want to make up front, it's just that based on our research, based on our experience, we do not think that there is any compromise on financial returns whatsoever. ESG integration is when you're taking into account the full gambit of how companies operate, how they impact the environment and society, and how that reflects in their outlooks as well. If a management team takes account of the environmental impact it has, or the risks that environmental change may have to its business, or if they think about diversity and inclusion in terms of how they retain people, we think it's more likely that that management team is also going to be able to see other opportunities and other risks and be prepared for them. And if they're prepared for these, that means that they're more likely to succeed in terms of being able to drive growth, free cash flow, profitability, and that has really important ramifications for their valuations if investors trust in that. And we've researched this. So they're closely entwined. We've researched that as part of our DNA. It's not just a finger in the air. Like last year, we published a white paper in which we focused quite uniquely on the technology sector. And what we did was we bucketed the entire universe of technology into like-for-like buckets. So by market cap, by margins, by growth. And we looked at how like-for-like companies compared on valuation and compared to their ESG standards. So what we were trying to do was isolate ESG as a metric and to take the debate out of it on how do we look at good ESG standards versus we use both the leading third-party scoring and also our own internal ranking scheme. And the research showed consistently that higher ESG standards resulted in higher valuation. Now, valuation and stock price performance are not the same thing, but what it shows is that investors will put a higher valuation or address a lower cost of capital to those companies that they trust, those companies that are taking this broader view. And think about, just as an example, how a Meta or a Microsoft may be perceived from an ESG perspective, and with similar growth rates, similar margin structures, Microsoft has a much higher valuation. And that's got real ramifications. You can see that when we see things like ChatGPT or AI, when someone like Microsoft brings that to the market, because we trust it, we also, there's faster adoption, and that creates growth opportunities. The research also helped us to think about ESG integration in terms of value traps, and that's really avoiding those companies if they don't look at externalities and plan for that, if they're not considering the risks that the environment or society poses, then we're ignoring the fact that those companies ignore risk, and that really doesn't fulfill our fiduciary duty as investors to consider that. We're continuing on that forward-looking research, because what we're looking at again this year is looking at just quantifying also the role that we as active investors can play as companies look to improve their ESG standards. Because if companies can prove to investors that they are more forward-looking, then there's also an opportunity for them to improve their valuations. And we've seen a lot of engagement, not just from our investors, but from the corporates that we invest in who've wanted to see this research and engage with us to understand how they can build that trust with their investors more as well. And when it comes to sustainable investing, that investment with purpose mandate you mentioned, that's a slightly different focus, because as well as that ESG integration piece I mentioned, it's also about thinking about what the companies actually do, what the purpose, what are the outcomes that come from the activities that they are involved in. And companies who have products and services who address social and environmental problems, well, they tend to face very large addressable markets and also growing addressable markets. And we think about that in a few different ways. I mean, just to give a few examples, take electrification. It is a key means to decarbonise, but the infrastructure that is needed for decarbonisation, from renewable energy to semiconductors, for power management, these are looking at some of the highest growth areas of the market, significantly higher than GDP. Again, AI, that's very topical. You've heard a lot about it, but if we move to AI and autonomous vehicles, we can reach that 90% of road accidents that are caused by human error. But all of that type of AI needs an incredible amount of connectivity, infrastructure, and the energy needs are huge. So being able to address that means that we're aligning with some of the highest growth areas of the market when we're seeking out investments with a purpose to be able to enable many of these. So, when we're looking at sustainable areas, we're also looking at areas that can be a priority for governments. And even in economic downturns, that can mean that those can also be less cyclical as well. So, I hope that gives you some colour on the difference between the ESG integration and sustainable investment, and hopefully also show that, that from our research, that financial and non-financial factors are just inextricably linked. And, for us, they really complement each other rather than competing with each other.
Thanks so much, Alison. And one thing you mentioned there, your white paper. I just wanted to elaborate that. Our philosophy here is research, engage, educate. Come up with these differentiated insights that add value to our clients. Educate internally. Ensure all our analysts and PMs are aware. Engage with our portfolio companies to help them become better companies, but also educate externally. Educate our clients, and we will become increasingly open and public about some of the research that we are doing. As Alison articulated, we do believe that environmental, social, and governance factors can be financially material. Where they are, we strive to integrate them to help enhance returns for our clients. We don't make decisions based on factors that are not financially material. There are a couple of questions. We actually don't have a lot of time right now, so we will be addressing those individually with the journalists who pose them. So I'm going to hand this back to Sarah.